Most investors think this is normal. It isn't. Silver looks calm right now. No panic, no breakout, no headlines screaming crisis. And that's exactly why this moment matters. Because markets don't usually break when everyone is afraid. They break when everyone is comfortable. Right now, silver feels boring. Flat price, low volatility, no urgency. But that quiet is doing something dangerous. It's training investors to ignore it. And historically, that's when positioning becomes one-sided. This is where traps usually form. Let me explain. Most people believe silver only moves when something obvious happens. Inflation spikes, the Fed pivots, a geopolitical headline crosses the wire. Until then, they assume nothing is happening. But silver doesn't work like that. Silver is a plumbing market. Stress shows up in flows long before it shows up in price. Vault movements, delivery behavior, lease rates, regional premiums. These don't make headlines. But they're where problems begin. And right now, those signals are quietly shifting. I'm not saying silver breaks tomorrow. I'm saying this is where imbalances usually start. By the end of this video, you'll understand what looks normal right now, what's actually changing underneath, and why that gap matters for anyone holding silver or relying on markets to stay orderly. No price predictions, just risk mechanics. Here's what most investors currently believe. They believe silver is simply consolidating. They believe demand is soft. They believe supply is adequate. They believe price reflects reality. That's the surface story. Underneath, something else is happening. Physical silver is slowly moving out of visible inventories. Not dramatically, not in a way that creates headlines, just steadily. Registered stockpiles are tight relative to historical norms. Eligible inventories exist, but they aren't obligated to be sold. That distinction matters because registered metal is what's actually available for delivery. Eligible metal is just metal sitting in vaults. It belongs to someone, and owners don't sell unless price forces them. This is the part most investors miss. Paper markets assume that eligible metal becomes supply when needed. In reality, it only becomes supply if someone agrees. That difference is everything. At the same time, we're seeing rising physical interest outside the Western futures system. Asia continues to pay premiums over Western spot prices. Not extreme premiums, persistent ones. That tells you something important. It tells you silver is more valuable elsewhere than it appears on US screens. That's not speculation. That's arbitrage pressure. And when one region consistently pays more, metal flows toward that region. Slowly at first, then suddenly. Here's where things change. Arbitrage only works while metal is freely available. Once logistics tighten, price gaps stop closing. They widen. And that's when futures markets start losing control over physical pricing. We've seen this pattern before. Nickel in 2022, energy in Europe, even treasury markets during stress events. Price stays calm, liquidity thins, then something small hits. And suddenly everyone realizes the exit is narrower than they thought. Silver behaves the same way because silver is both a financial asset and an industrial input. That combination makes it fragile. On one side, you have investors. On the other, manufacturers who physically need the metal. Investors can sell, factories cannot. When supply tightens, industry doesn't negotiate with charts. They secure material, quietly, directly, often off exchange. That removes metal from visible systems, which makes paper pricing less representative over time. This is why this matters. Most investors watch candles. They don't watch availability. But shortages don't announce themselves through price first. They announce themselves through behavior. Delayed deliveries, longer settlement times, higher regional premiums, more off-market transactions. These are early signals. Right now, we're seeing several of them at once. Not extreme, but aligned. At the same time, speculative positioning is relatively light, which sounds healthy. But it also means price is being supported mostly by structural demand, not momentum traders. That creates stability until it doesn't. Because when flows matter more than sentiment, moves tend to be abrupt. This is the part most investors miss. Silver doesn't gradually reprice under supply pressure. It gaps. Not because people panic, because physical buyers don't wait. They secure inventory. And futures markets have to catch up. I'm not saying this creates a straight line upward. Markets never move in straight lines. I'm saying this is where asymmetry begins to form. Downside feels limited. Upside becomes disorderly. That's not hype. That's market structure. Another layer here is confidence. Paper silver only works as long as participants trust settlement. Most of the time, they do, but that trust depends on metal being available somewhere. If availability tightens, confidence becomes conditional. That's when volatility returns, not from fear, from mechanics. Here's where things change again. Silver is increasingly classified as a strategic input. Solar, electronics, defense, grid infrastructure, that shifts how governments and corporations think about supply. They don't treat it like jewelry. They treat it like energy. You don't leave energy security to spot markets. You secure it in advance, which means less metal circulating freely, which means thinner buffers. And thinner buffers mean sharper reactions to small disruptions. This is why this matters. Nothing seems wrong, But that's exactly what conditions look like before liquidity becomes visible, before spreads widen, before delivery delays surface, before price disconnects from availability. This isn't about predicting a number, it's about recognizing setup. Silver right now is quiet. But quiet doesn't mean stable, it often means positioned. If you're holding silver, this isn't a call to action, it's a call to awareness. Understand what you own, understand where price comes from. Understand that paper markets reflect confidence, not inventory. And confidence only holds until it doesn't. I'm not saying this breaks tomorrow. I'm saying this is where problems usually start. When everything looks fine, when nobody is watching, when positioning becomes comfortable. That's when markets quietly load risk. If this kind of risk analysis helps you think clearly, consider subscribing. Not for predictions, for early signals, because by the time headlines change, positioning already has. And silver doesn't announce stress loudly. It waits. Nothing seems wrong in silver, and that's the problem. The real question is, what happens when quiet demand meets limited availability? That's what comes next. The next layer most investors don't see is leverage, not retail leverage, system leverage. Silver is one of the most heavily intermediated commodities in the world. For every physical ounce, there are dozens of paper claims layered on top. Futures contracts, options, swaps, unallocated accounts, structured products. Most of the time, that structure works because most participants never ask for metal. They cash settle. But this is where fragility enters the system. Paper silver assumes that only a small percentage of holders will ever request delivery at the same time. It's a probability model, not a guarantee. As long as behavior stays predictable, everything clears, the risk appears when behavior changes. We're already seeing subtle signs of that shift. More participants are choosing allocated storage instead of pooled accounts. More industrial buyers are negotiating directly with refiners instead of relying on exchange inventories. More metal is moving into private vaults instead of remaining visible in public warehouses. None of this creates headlines, but together it tightens the float. This is the part most investors miss. Liquidity isn't just about trading volume. It's about deliverable supply. A market can look active while becoming fragile. You can have millions of contracts changing hands while the actual metal available for settlement quietly shrinks. That's how disconnects form. And when disconnects form, price stops being the primary signal. Availability becomes the signal. Another pressure point is timing. Silver production isn't flexible. You can't turn on new mines overnight. Most silver is produced as a byproduct of copper, lead, and zinc mining. That means supply responds to base metal economics, not silver demand. So when silver demand rises independently, the system can't quickly adjust. It draws down inventories instead. That's exactly what we've been seeing. Gradual withdrawals, steady industrial offtake, no dramatic shortage, just erosion. Slow erosion is dangerous because it doesn't trigger alarms. It feels manageable, until suddenly it isn't. Here's where things change. Once inventories reach a certain threshold, participants start behaving differently. Traders become cautious about short exposure. Industrial buyers increase buffer stock. Vault operators prioritize existing clients. The system shifts from abundance to preservation. That transition doesn't show up in price charts right away. It shows up in policies, minimum order sizes, longer delivery windows, higher premiums for guaranteed supply. These are early stage signals. And they're appearing quietly. I'm not saying this creates an immediate crisis. I'm saying the structure is becoming less forgiving. When buffers shrink, small shocks matter more. A logistics disruption, a refinery outage, a surge in industrial orders. Any of these can suddenly move markets that previously felt stable. This is why calm periods in silver deserve attention. They allow leverage to build. They allow inventories to drift lower. They allow confidence to become complacency. And complacency is what makes transitions violent when they finally arrive. Nothing looks wrong. But the margin for error is narrowing. That's the risk, not volatility, not headlines, structural sensitivity. And once a market becomes sensitive, it doesn't need a major event to move. It only needs something minor to expose what's already underneath. Confidence doesn't collapse all at once. It erodes, quietly. Most market disruptions don't begin with panic. They begin with small operational adjustments that few people notice. A delivery window quietly extends from 5 days to 10. A wholesaler asks for prepayment instead of net settlement. A vault introduces new storage terms. Individually, these changes look procedural. Collectively, they signal stress. This is the part most investors miss. Markets don't tell you they're becoming fragile. They show you through behavior. Silver is no exception. When participants start prioritizing physical certainty over paper convenience, it tells you something fundamental is shifting. It means availability is becoming more important than price. And once that happens, futures markets stop being the center of gravity. They become a reference point. That's a subtle but critical transition. Historically, this is how metals markets move from financial instruments back into commodities. Not suddenly, gradually. First, industrial buyers begin securing longer-term supply. Then, refiners reduce spot exposure. Then, vault operators favor existing clients over new ones. None of this is dramatic. But each step removes optionality from the system. Optionality is what keeps markets smooth. When optionality disappears, volatility follows. Another layer here is counterparty perception. Most investors assume settlement is guaranteed. In reality, settlement is conditional on trust. Trust that counterparties can perform, trust that metal is available when requested, trust that contracts mean what they say, that trust holds remarkably well, until there's a reason for it not to. What creates that reason? Usually something small. A missed delivery, a forced cash settlement, a regulatory change, a sudden premium divergence between regions. These aren't catastrophic on their own, but they change behavior. Once participants begin questioning assumptions, they act differently. They reduce exposure. They seek physical custody. They shorten time horizons. And those actions amplify stress. This is where things change. Confidence isn't lost because price moves. Price moves because confidence is lost. That sequence matters. By the time charts reflect instability, positioning has already shifted underneath. We've seen this pattern repeatedly across markets, in funding markets, in energy, in sovereign bonds. The early phase always looks the same: stable pricing, falling buffers, rising dependence on trust. Silver fits that template. Right now, silver still trades as if everything is normal. But the structure supporting that normality is thinning. Inventories are tighter. Supply is less flexible. Industrial demand is persistent, and leverage remains embedded in the paper system. That combination doesn't guarantee disruption, but it does increase sensitivity, which means outcomes become more dependent on small variables. This is why this matters. In sensitive systems, you don't need big shocks. You only need asymmetry, more demand than expected, less supply than assumed, less confidence than modeled. That's enough. I'm not saying this leads to immediate chaos. I'm saying this is the phase where probabilities begin shifting, where risk becomes directional, where stability depends on everything continuing to go right. And markets rarely offer that luxury for long. Nothing seems wrong. That's precisely what makes this stage important. Because by the time something looks wrong, the opportunity to think calmly has usually passed. The real question isn't whether silver will move. It's how prepared participants are for a change in behavior when it does. That's what Part 4 will focus on, not price targets, not forecasts, just what typically happens next when confidence starts thinning in physical markets. Let me know when you're ready to continue. What usually comes next isn't dramatic, it's procedural. Markets don't announce transitions. They implement them quietly. Credit terms tighten, delivery windows stretch, risk managers reduce limits, position sizes get smaller. None of this looks like a crisis. It looks like routine adjustment, but these adjustments change behavior. Participants become more selective about counterparties. Dealers prioritize long-term clients. Industrial buyers increase buffer inventories. Traders become reluctant to provide liquidity at previous levels. Liquidity doesn't disappear, it thins. And thin liquidity is what turns ordinary moves into outsized ones. This is the part most investors overlook. They expect volatility to arrive first. In reality, flexibility disappears first. When flexibility is gone, price becomes reactive instead of expressive. Small imbalances start producing large responses. Silver is approaching that zone, not because something is broken, because the system is becoming less elastic. Physical supply is less visible, inventories are tighter, demand is steady, leverage remains embedded. That combination reduces margin for error. Here's where things change. At some point, participants stop assuming abundance. They start assuming scarcity. That doesn't require a headline. It only requires a few experienced operators deciding that availability matters more than price. Once that mindset spreads, behavior shifts quickly, contracts get rolled instead of closed, physical delivery becomes preferred over cash settlement. Optional exposure turns into strategic positioning. Again, none of this is emotional, it's rational, but it alters the character of the market. Silver stops behaving like a passive asset and starts behaving like a constrained resource. When that happens, price discovery becomes uneven, moves come in steps. Periods of calm are followed by sudden adjustments, not because of speculation, because supply chains are being recalibrated in real time. This doesn't mean silver has to surge. It means the range of outcomes widens. Stability becomes conditional, and conditional stability is fragile. I'm not saying this becomes disorderly tomorrow. I'm saying we're entering the phase where outcomes depend more on logistics than sentiment, where availability matters more than narratives, where quiet positioning matters more than headlines. This is why nothing seeming wrong is actually the signal. It tells you risk is being built quietly, without emotional release. That's how structural transitions always begin, slowly, silently, until they aren't. If you hold silver, or if you rely on markets to remain orderly, the important thing right now isn't prediction, it's awareness. Understand how this market functions, understand the difference between price and supply. Understand that confidence is an input, not a guarantee. Because when confidence becomes conditional, markets don't ask for permission to reprice. They simply adjust. If this kind of risk analysis helps you think clearly, consider subscribing, not for excitement, for perspective. Nothing seems wrong in silver, and that's the problem. The real question going forward isn't what silver does, it's how participants behave when availability becomes more important than convenience. That's the phase we're approaching, and that's where markets reveal their true structure.